Jesse Livermore's entire speculative philosophy was built upon this foundational principle. He was not interested in trading every day or even every month. He was interested only in trading during those specific and clearly defined market conditions where the probabilities of a great and profitable swing were overwhelmingly in his favor. He knew that his job was not to be a constant participant, but a vigilant opportunist. To understand the market conditions Livermore loved most is to understand the anatomy of a true, healthy, and powerful bull or bear market. It is to learn to see the market not as a chaotic jumble of random price movements, but as a campaign, a great unfolding drama with a clear plot, a definite direction, and a cast of leading characters. This approach, this profound understanding of market character, is the central theme that runs through the entire chronicle of his speculative life. The wisdom he acquired, often at a terrible price, was documented with brilliant clarity by Edwin Lefèvre. A link to his indispensable work, Reminiscences of a Stock Operator, can be found in the description below this video for any student who wishes to learn from the master himself. This is a deep analysis of that ideal market, a dissection of the specific signs and conditions that, when aligned, would cause Livermore to move from a state of watchful inactivity to one of decisive and massive engagement. These were the conditions he would wait for, sometimes for a year or more, knowing that one such campaign could be the work of a lifetime. The first, the most fundamental, and the most non-negotiable of all conditions was the existence of a definite primary trend. The market, in its broadest sense, as measured by the major averages, had to be in a clear, unmistakable, and sustained bull or bear line. All other considerations were secondary to this one, great, overriding fact. He held it as an article of faith that the big money was never in the individual fluctuations, but in the main movements. He knew that trying to trade against the primary trend, or trying to force a profit from a confused sideways market with no clear direction, was the surest path to the poorhouse. The speculator must always be on the side of the dominant force. He would study the action of the market averages with the intensity of a general studying a battlefield map. Were they making a series of higher highs and higher lows, confirming a bull market? Or were they making lower lows and lower highs, signaling a bear market? The answer to this question determined his entire posture. He was either a bull in a bull market or a bear in a bear market. He was never a bull in a bear market trying to be a hero by picking the bottom. Nor was he a bear in a bull market trying to prove his genius by calling the top. He was a humble servant of the great primary trend. To trade without the confirmation of the general market's trend was to him the height of folly. It was to bet on a single soldier's ability to win a battle while his entire army was in full retreat. The speculator must have the powerful tide of the whole market with him. The second critical condition he demanded was the emergence of clear and powerful leadership. A healthy bull market is never a case of all stocks rising gently and equally. That is the sign of a tired, late-stage market. A young, powerful bull market is always, without exception, led by a small handful of dominant industrial groups and their star-performing stocks. These leaders are the generals of the market's new campaign. They are the first to break out from their long consolidation bases. They are the ones that advance with the greatest velocity and power. They are often the stocks that are making new all-time highs, while the majority of other stocks are still dormant. Livermore loved to see this clear, concentrated leadership emerge. It simplified the game. Instead of having to watch 1,000 different stocks, he could focus his entire attention on the few dozen true leaders, the thoroughbreds of the market. It was here, and only here, that the great money was to be made. He had no interest in the laggards, the low-priced, sluggish stocks that the amateur in his search for a bargain is so often drawn to. He knew that the laggards were weak for a reason. His great principle was to buy strength, not weakness. The emergence of these clear, powerful leaders was the market's own announcement of where the game was being played. It was the signal to the observant speculator of where he must concentrate his forces if he wished to profit from the new primary move. The third condition, which was inseparable from the second, was the harmony of group action. A true market leader does not advance alone for long. A key characteristic of the market conditions Livermore loved was that the leader's entire industrial group would, in due course, confirm its move. If a powerful steel stock broke out to new highs, he would immediately turn his attention to the other major steel stocks. He would demand to see them exhibit sympathetic strength. They did not all have to move on the same day, but they needed to show signs of life, of accumulation, of a willingness to follow their general. This group action was the undeniable proof that a fundamental and powerful force was at work in that entire sector of the economy. It was a sign that the smart money was not just interested in a single special situation, but in the prospects of the whole industry. A breakout in a single stock, unconfirmed by its sister stocks, was always suspect. It was like a single soldier charging ahead of his regiment. He might be brave, but his advance was unsustainable. A charge by the entire regiment, however, was a force to be reckoned with. Livermore had more confidence in a mediocre stock in a strong, advancing group than he did in a seemingly brilliant stock in a weak and dormant group. He always sought to have the power of the group trend behind his plays. The fourth condition, the great verifier of all market action, was the testimony of the volume. A genuine, healthy market trend, the kind of market Livermore loved, is always a high-volume affair. Volume is the fuel in the engine of the market, and a great move requires a great deal of fuel. He loved to see the volume of trading expand dramatically as the market and its leaders broke out of their bases and began their advance. This explosive volume was the footprint of the great institutional players, the insiders, whose aggressive buying was financing the new trend. A breakout on low anemic volume was a whisper, not a shout, and it was never to be trusted. Equally important was the character of the volume during the inevitable minor pullbacks that occur within a major trend. In the ideal market condition, these pullbacks would always occur on sharply diminished volume. This was the proof that the selling was not aggressive, that the stock was in strong hands, and that the retreat was merely a temporary pause, not the beginning of a rout. This constructive volume signature expansion on the advances and contraction on the declines was the market's own heartbeat. It was the sign of a healthy, vigorous, and sustainable trend. A dull, lifeless, low-volume market was a market of indecision, a place where the professional speculator had no business risking his capital. The fifth and more subtle condition that Livermore looked for was the market's psychological character, specifically its reaction to the news. He understood that the tape is not driven by the news, but that the news is often a lagging indicator of what the tape has already discounted. The market's reaction to the news, however, was a profound clue to its underlying health. In a powerful and deeply rooted bull market, the market has a curious habit of ignoring bad news. A negative political event or a poor economic report might cause a brief one-day sell-off, but the market would quickly shrug it off and resume its confident advance. This was the sign of a profoundly bullish internal character. This is the market climbing a wall of worry. Conversely, in a bear market, the market would consistently ignore good news. A surprisingly positive earnings report would fail to lift a stock. A peace treaty would fail to spark a rally. This demonstrated that the underlying pressure, the line of least resistance, was still downwards. This is the market sliding down a slope of hope. Livermore loved the defiant character of a bull market that was immune to bad news. It was the ultimate proof that the great unseen forces of accumulation were still in complete control, and that the primary trend had a long way yet to run. The sixth condition, and the one that represented the purest expression of a powerful trend, was a market where the leading stocks were breaking into new all-time high ground. To the amateur, a stock at a new high looks dangerous and too high. To Livermore, it was the most bullish signal a stock could possibly give. A stock making a new all-time high is a stock that is in a position of supreme and demonstrated strength. It has absorbed all the old selling pressure. There is no overhead resistance from buyers who got trapped at a higher price in a previous move. The stock is sailing in clear, open water. This was the condition that promised the most explosive and frictionless moves. The path of least resistance was not just upward, it was a vacuum. He knew that a stock in this position had a potential for advance that was literally unlimited and impossible to predict. He was not afraid to buy at a new high. In fact, it was his preferred point of entry. It was the ultimate confirmation that he was aligning himself with a powerful and victorious force. It was the very definition of buying strength. The seventh condition was the psychological state of the public. In the early and middle stages of the great bull markets that he loved to trade, the general public was typically skeptical, fearful, or completely uninterested. The financial pages were not yet on the front page of the newspapers. This was a profoundly bullish sign. It was the proof that the move was still in the hands of the smart money, the professionals who accumulate their lines in quiet. The market was still climbing a wall of worry, a sure sign of a healthy and sustainable trend, the condition he knew to be a great danger signal, the sign that the end of the bull market was near, was when this psychology reversed. It was the moment when the public, after a long and spectacular advance, finally shed its skepticism and rushed into the market in a frenzy of greed. It was the moment when his barber, the elevator operator, and the shoeshine boy all began to offer him stock tips. This was the sign of the final speculative mania. He knew that the smart money was now quietly selling its holdings to this great, hopeful, and ultimately doomed public. This was a market condition he hated, for it signaled that the great, profitable game was over. What then of the other side of the market? Livermore loved the clear and decisive conditions of a new bear market just as much as he loved a bull market. The principles were the same, but inverted. The ideal condition for a major short-selling campaign began at the tail end of a great bull market, after the public had been drawn into a speculative mania. He would wait for the true leaders of the bull market to stop making new highs. He would watch for them to begin churning on massive volume, a clear sign of distribution. He would wait for the market to begin ignoring good news. He would wait for the major averages to break their upward trend line and to violate a key support level. When all these conditions aligned, he knew that the line of least resistance for the entire market had definitively shifted from upward to downward. He would then begin his short-selling campaign, focusing on the old, tired leaders that were now the weakest stocks in a newly weak market. The clarity of a new bear market was a condition he relished, for it offered the same kind of great primary swing as a bull market. The path was clear. His job was simply to align himself with it. The one condition he could not abide was confusion. In the final analysis, the market condition Jesse Livermore loved most was a condition of absolute, unambiguous clarity. He was a general who refused to commit his army to a confused and foggy battlefield. He demanded clear skies and a definite line of engagement. This ideal condition can be summarized as follows: a definite primary market trend, either bull or bear, that is being clearly led by a few powerful industrial groups and their star-performing stocks. This leadership must be confirmed by harmonious action among the sister stocks in the group. The entire movement must be financed by a decisive and constructive volume signature, with volume expanding on the advances and contracting on the declines. And finally, the market must possess a psychological character that confirms its own internal strength, by ignoring bad news in a bull market or good news in a bear market. These perfect ideal conditions are rare. They do not occur every month or even every year. There are long, frustrating periods of dull, sideways action where none of these conditions are met. And this is the final great lesson. The true genius of Jesse Livermore was not just his ability to recognize these perfect conditions, but his profound and unwavering discipline to do absolutely nothing until they arrived. His greatest profits were his reward for his greatest patience.